The stock market has experienced periodic crashes for a century. Regardless of how frequently these crashes occur, each one feels equally unexpected and distressing. To safeguard yourself from the next market crash, first step is comprehending the underlying reasons behind these crashes. A stock market crash represents a social phenomenon, emerging from the interplay of economic events and crowd behavior psychology, both of which are human-driven forces contributing to a spiraling effect. Disasters and government regulations can be contributing factors to stock market crashes, but most crashes occur as individuals overspend and purchase assets above their intrinsic values. As the stock market fluctuates between states of overvaluation and undervaluation, transitioning from euphoria to recession, we gauge the likelihood of a recession by assessing the P/E ratio, which indicates the degree of overvaluation in the stock market. Although there are no foolproof indicators or metrics that can definitively predict the future direction of stocks, one of the most accurate forms is the Shiller P/E ratio, also known as the CAPE ratio. Its formula is straightforward, dividing the current price by the average inflation-adjusted 10-year EPS. This ratio was popularized by the renowned Nobel Prize-winning economist, Robert Shiller, and has a noteworthy track record in forecasting stock market downturns. There have been merely 5 occasions, dating back to 1870, when the Shiller ratio surpassed reading of 30. The S&P index experienced a decline of at least 20% on all 5 occasions. Prior to the dot-com bubble, the Shiller P/E ratio reached an unprecedented peak of around 44.2. Over the subsequent years, the market witnessed a substantial decline of 49% in its value. In 2018, once again the Shiller P/E ratio surpassed the critical threshold of 30. In the fourth quarter of the same year, the S&P 500 index experienced a significant plunge of 20%. Before the coronavirus crash in March 2020, the Shiller P/E ratio exceeded 30 once again. Subsequently, the S&P 500 experienced a staggering loss, shedding 34% of its value. In January 2022, the S&P Shiller P/E ratio exceeded 40, marking the first time since the dot-com bubble. Subsequently, benchmark index experienced a significant decline, losing 26% of its value. Although a Shiller P/E ratio of 30 often signals an impending bear market, historical data indicates that bear markets have tended to find support around a Shiller ratio of 22. If you believe that selling stocks because the market is currently overvalued will guarantee protection from an eventual crash, that assumption is incorrect. Attempting to outsmart the market by buying low and selling high, no matter how confident you feel, is not a recommended strategy. In the dot-com bubble of 2000, the stock market started showing signs of technical overvaluation as early as 1996. However, it took another 4 years for the market to crash, during which it continued to rise by an additional 50%. If you had withdrawn your money in 1996, you would have faced significant losses. Attempting to time the market by selling high and buying low is akin to gambling in Las Vegas. You might end up being years too early or days too late, missing out on potential gains or suffering significant losses. Over the course of the past 9 decades, growth years have made up 75% of the total years, thus returning 11% CAGR for long-term investors. Data suggests that if you choose to keep your money invested in the stock market for the long term, the likelihood is high that you will see positive returns and make money.